Quick disclaimer before we start. I'm not a financial advisor, and nothing in this video is financial, investment, tax, or legal advice. This is my personal experience and opinion, shared for education and entertainment only. I am not recommending you buy or sell anything. Investing carries risk, including the loss of your capital, and past performance does not guarantee future results. I may hold the assets discussed. Always do your own research and speak to a licensed professional before making any decision. 2 years ago, a chunk of my portfolio was sitting in QYLD, collecting what looked like a 12% yield every month. It felt fantastic. Then I did the math on what that yield was actually costing me, and I moved all of it into JEPI and JEPQ. In this video, I'll show you exactly why, with the numbers, the mechanics, the tax angle, and a backtest of the switch. All three are covered call ETFs. They own stocks, then sell call options on them to generate cash. That cash becomes your monthly distribution. The catch is that selling calls caps your upside. When the market rips higher, you don't come along for the full ride. But the mechanics differ in a way that matters. QYLD writes at the money calls directly on the entire NASDAQ 100, capping almost all upside every single month. JEPI and JEPQ keep more of the market's gains. The reason comes down to how they generate income, and that's worth slowing down on. Here's the part most videos skip. JEPI and JEPQ don't write options directly. They hold equity-linked notes, contracts with a bank that bundle the stock exposure and an out-of-the-money call together. Because the call is struck above today's price, the fund captures some upside before the cap kicks in. QYLD, writing at the money on the whole portfolio, gives that upside away immediately. Same idea, very different payoff shape. Now here's the chart that changed my mind. QYLD launched at $25 a share. Today it trades far lower. That's not a crash, that's the structural erosion of paying out more than the fund earns month after month for years. Yield is a distraction. Total return, price plus reinvested distributions, is the only honest scoreboard. Over the last 5 years, QYLD returned far less than the underlying NASDAQ 100. You collected income while leaving a large share of the gains behind. And the headline yield hides something. As the share price falls and volatility compresses, the actual dollars you receive shrink. Monthly payouts that were around 23 cents in 2021 are closer to 17 cents now. The percentage looks steady only because it's measured against a smaller and smaller base. So why JEPI and JEPQ instead? Both are actively managed by JP Morgan and cost 35 basis points versus QYLD's 60. JEPI holds lower volatility, S&P 500 names for a smoother ride. JEPQ runs the same playbook on the NASDAQ 100 and swings harder. I hold both, weighted equally. Does keeping more upside actually show up? Over the past year, in a NASDAQ-led market, JEPQ returned far more than JEPI. That's the volatility difference doing its job. The point isn't that one is best. It's that both participate in growth in a way QYLD's at-the-money structure simply can't. There's a subtler problem with a fund that erodes its own capital. If your principal is shrinking while you draw income, a few bad years early can permanently damage the base that generates that income. This is sequence of returns risk. A fund that grows its NAV gives you a cushion against it. A fund that bleeds NAV removes that cushion exactly when you need it most. Tax matters more than people admit. In the US, these distributions are largely ordinary income, so they belong in a tax-sheltered account where you can hold them. For European investors, it's different again. Many US domiciled funds like these aren't easily accessible, and withholding tax on distributions takes a bite. Whatever your jurisdiction, the rule is the same. Judge these on after-tax total return, not the headline yield. How do I actually use them? I treat JEPI and JEPQ as an income engine, not the whole portfolio. They sit alongside growth holdings, not in place of them. I weight the two equally, JEPI for stability, JEPQ for more growth and a higher yield. And I size the sleeve so the income matters without the capped upside dragging on my overall compounding. The income gets redirected into uncapped growth, not spent. So what did switching actually do? I took the same starting capital and compared two paths over the same window, staying in QYLD versus an equal split of JEPI and JEPQ with distributions reinvested. The JEPI-JEPQ side ends with meaningfully more total value because it kept participating in the market's growth while still paying income. The yield was slightly lower, but the preserved and growing capital more than made up for it. To be fair to QYLD, in a genuinely flat or sideways market for years, its rich premium income can win because there was no upside to give up anyway. And all of these throw off heavily taxed income, so they belong in a tax sheltered account where you can. This isn't a scam, it's a tool that was wrong for my goals. My takeaway: if you're years from needing the cash and you're building wealth, a fund that structurally erodes its own NAV is working against you. I'd rather take a slightly lower yield and keep the growth. If this helped, subscribe and let me know in the comments what you hold for income.